So good evening, everyone, and welcome to our latest episode of our biweekly webinar series. I'm Dr. George Ozude of Time Health Capital, and we have Dr. Bayo Fasanya. He and I are your hosts. And this evening, we are excited to bring on Baskal Korkis, who is our expert guest. He's the CEO of KOR Capital Fund. Baskal is a friend of mine who I've come to know over the last 2 years through the Real Estate Guys Mentoring Club. He is a successful young real estate investor, as well as an investor in energy and technology. He's a financial specialist and visionary entrepreneur. His career in real estate began at the age of 19, as Nancy was explaining to us, and today he owns over 16 buildings in the Tampa Bay area of Florida. So Baskal is a very influential thought leader and educator. And as Nancy mentioned, he has amassed over 200,000 followers on Instagram. He's been a mentor to myself and Bayo over the last year, and he's had a ton of energy and channels it through all his endeavors and commitment to excellence. So we're excited to bring him on and learn from him this evening in what will be an open format with Q&A to drive the discussion. And so Baskal, I know that's kind of high level, and there's tons of more things that you do that's on your resume and your CV. So I want to kind of let you get an intro in on yourself and kind of explain your background and all you've done up until this point.
All right. So I learned about real estate when I was very young, 14 years old, and was wowed because I came from a third world country where it was really hard to own property. So the fact that it was not a large corporation or the government owning these properties was very surprising to me. So from 14 and 19, I learned about everything I could to own real estate. I worked for different experts in property management, construction, purchasing, the mortgage industry, learned about credit, taxes, anything that I needed to learn so I could increase my probability of success. And through those years, I figured out what was going to increase my probability of success. So I started doing more of those things and figured what was going to reduce the probability of success and reduced doing those other things. Very high level, that's what I did. So 19, I bought my first duplex. The next year, I bought another one. 6 months later, I bought a 7-unit. But at 23 years old, I had 23 units, and I rolled $30,000 through all those deals. So that $30,000 was able to help me generate $3 million in real estate in that period of time. Finance is amazing in America. It's really different than it is any other part of the world. You know, we have a very modern monetary system. So if you know how to use it, it is in your favor. If you don't know how to use it, unfortunately, you can get swept into the negative side of our system and end up becoming either middle class or poor. So I'm here to answer any questions regarding taxes, credit, real estate investing, property management. We have a insurance agency, we have a mortgage company, we have an accounting firm specialized in high net worth individuals and real estate investors. We have a property management company, we have a construction company, in-house architects and engineers. We have and then investment firm, which then does A to Z for our clients. So any questions you have, I'm more than happy to.
Perfect. Yeah, we're going to invite folks to leave questions in the chat box. You can also come off mute and ask questions. And I wanted to try to get things started just by starting on the residential side of your portfolio. I wanted to let folks know about your unique approach to value add. You know, we talk about this a lot when we were down there in Florida, in Tampa. I want folks to kind of understand and hear that unique approach, not just the paint and carpet, right? True value add to your properties. Could you explain about that?
Sure. So a lot of people will say they do value add. And when they're saying they do value add, they're normally putting down paint, they're painting the buildings, they're changing the carpet, or putting in like luxury vinyl plank, spending very little money on the property. And that for me is not value add. What we do is we buy properties and we prefer to gut them to the studs. What that means is we rip everything out, even the drywall, we rip everything out, and we check all the wood. if it's a wood building. If it's block, we check the block. And we improve on what's there. So we add additional wood. We use pressure treated wood. So it removes, so termites don't like eating pressure treated wood. Mold and mildew doesn't grow on pressure treated. It's resistant to mold and mildew as well. From there, we put all new electric, all new plumbing, new AC systems, all new spray foam insulation, new drywall that's mold and mildew resistant. We put in water filtration system, specialty systems. From there, new water heaters. So we make it energy efficient and we make them green and clean. So the water's triple filtered and softened before you drink from it. It's double filtered and softened before it touches your skin. And our AC system is better quality, so it pulls out mold, mildew, and pollen. So we do all that to our buildings, and you'd think that sounds like a lot of money. The reality is, if you do everything right, it doesn't cost that much more than if you put in a cheaper quality product, because the labor is the same. You put in cheap quality, you put high quality, labor is the same. Now, when you're putting in all high quality products, you're able to target clients that are able to afford that. So you can target nurses and doctors and other professionals that are earning, 70,000 plus. With that said, when we're doing a full gut reno and everything's being made new, we also try to target areas where the upper middle class would like to live, because they're going to be able to afford these nicer products, and they're also going to be able to withstand inflation. If you put out high quality in a low income neighborhood, there's only a certain amount of increase you can do to the rent, where if you put the same type of effort and energy into, say, a middle class neighborhood or upper middle class neighborhood, your returns are 4 to 10 times that of, say, the other neighborhood. So we choose to be in the middle class and upper middle class neighborhoods.
Gotcha. Yeah, I think that's very cool, like, aspect of how you approach value add. It's different than I think anyone else. I don't think anyone else is really approaching it like that. Another different thing that you do, I don't see a lot of others, a couple of others, but you also are interested in longer term hold, not just the quick, quote unquote quick 3 to 5 year hold and then sell, essentially flipping, right? Tell us about that. Tell us how that kind of looks once you get to a point where some passive investors may want to exit. How do you approach that?
So I actually had a great conversation with another large investor. It was yesterday. And the analogy came to is a race car. If you are a race car driver and you're competing against all the other race car drivers, and or an example, other investors, for their overall average return, a race car driver that's going faster than everybody else and that's wasting a lot of gas has to take more pit stops and has to take more time to put in gas in their car or change the tires. If they beat up their car too much, they'll end up having to take more and more pit stops, and on average probably lose the race to someone else who is more steady on their, still pushing and striving for greatness, but steady. Well, a lot of investors will say, I'll bring in 18% return, 20% return, because what I'll do is I'll sell the property after 3 years and I'm going to get the big bang up front, and I won't hold it long term because my internal rate of return might look not as attractive long term. Because one, they're doing lipstick remodels, so there's not a lot of value by doing that, and they're not getting the best benefit for their investors, so they have to sell short term so it could look more attractive. But when that money has to take a pit stop and is now sitting in a pit stop longer than other people, then your return on that investor's money is less. So if an investor takes your money and takes your $100,000 and invests and say, I'm going to get you 18% or 20, and they'll do that for, say, 2 or 3 years, and then your money's sitting on the sidelines for a year. People forget to estimate that that 1 year that it's on the sidelines, or the 6 months it's on the sidelines before they can find another deal. You have to add that to your average return for your money, the average return you're doing with that one investor. So if John gives you 20% for 3 years in a row, but year 4, it's just sitting there before he has another deal year 5, that means you're actually not making 20%. The reality is you're only making 15%, because that year that it just sat there and did nothing, you have to average that across. The way I see it is, if you buy in great locations in the downtown core where there's the middle class and upper middle class live and want to stay, rents are going to keep going up. Property value is going to keep going up. So you're going to be able to continue with inflation. You're going to be able to get the benefit from inflation instead of being hurt by inflation. Then you don't need to sell the property in 5 or 7 years. You can hold the property for 15 years and still get a 15 to 18%, if not more, return on your IRR if all the decisions are made properly. So then you don't ever have to sit on the sidelines. Your money's never resting. You're always making it work for you, and you're constantly making more and more. You're growing your wealth more and more over time. So it's possible to do that. It's like Warren Buffett says, he wants to get 15% consistently with very little risk. If you can do that consistently, that is better than going for someone's 20% that you're not going to get that often. So that is more of my strategy, to get 15% or greater consistently. And I buy properties in the downtown core that it can be, it's beneficial for us when inflation happens, because our clients can pay for the higher rents, and then property values grow and our clients can consistently get income without having to put their money, have their money resting, so they can consistently bring a return.
Yeah, I'm the same way, same investment thesis. I'd rather hold something for the long term and just continue to profit off of it. If you buy right, how do you account for, say, like major CapEx that you would expect? I feel like that ties into the first question and kind of how you do your value add. But if you could.
So really, really good question. So there's 2 parts with that. Sometimes, and normally when we buy a property, we're going to do a full gut rental. So everything is new. So there's nothing really that's going to pop up for maybe 10 years, because if it's all new electric, plumbing, AC, windows, doors, roof, the only thing that's going to go bad in 10 years is the AC unit, which then you replace that. By doing this, you're going to get consistent revenue because you're not going to have anything major popping up. At that point, you'd say, well, what's going to happen in 10 years? With our investments, we target to do a cash out refinance every 5 years. So after 5 years, usually between year 2 and year 5, we're doing a cash out refi, and we're giving back our investors their initial capital. That's our goal. You give us 100,000 in 2 to 5 years, we're giving you back that 100,000. You have your money back, but you still own the property with us. That is called infinite returns. This is how you're making money off of no capital, no initial capital left. This net $100,000 that you just received is not taxable because it's through a cash out refi. And then you take the 100,000, roll it into another deal. When you roll into another deal with us, you're going to get another tax write-off, because we're going to do another cost segregation on the new building. So you're going to get another tax write-off. So you're going to get cash that's not taxable, investing into another deal and getting another tax write-off. At that point in time, during our cash out refinances, we will estimate what do we have coming in the next few years that was going to require CapEx. Are some of the AC units going to need to be changed? Does a pool need to be resurfaced? Do we, is the market, and this is one thing, the area has gotten from middle class to upper middle class and is teetering to higher class client base, where we should rip out the cement and put in pavers, give it that more luxurious feel so we can increase the rents even more, because we're now giving more of a luxury product. Certain things like that. Or property didn't have a pool, but we should add a pool because we're going to be one of the few people in this neighborhood, or one of the few complexes in this neighborhood that has a pool. I'm in downtown Safety Harbor, where the homes are like $1 million plus. Most homes don't have a pool, but my 16-unit complex has a heated pool. So it's very desirable to live with us. And when you just kind of have, the best way to explain it is, I'm not someone that has a finance degree that invested in real estate. I am someone that grew up learning real estate from real estate investors, people that own property and never sell it. So when you learn from people that own property and never sell it, you're going to treat your property differently. I don't like buying properties from flippers. A flipper does not care or respect the property. They want to go in, do the least amount of work, be very cheap on the property, just so they can make a lot of money when they sell. And if anything goes wrong in the next 2, 3, 4, 5 years, they don't care because they made their money, they're gone.
Right.
We respect our properties. We respect our tenants. We're good to the property. We're good to our tenants because we want to have a long-term relationship where we're all winning. We're all benefiting from each other. When you have that outlook, the way that you treat the real estate is going to be different. And your profitability, in my opinion, if it's done properly, your profitability is higher and more consistent.
Awesome.
Yeah.
Well,
I'm going to actually circle back to the earlier question about how you exit your limited partners. So, let's say someone, because that's one thing we run into as an operator. Are some most investors want you to have this kind of a timeline. They usually tell you what's the term, and you kind of just have to give them like, okay, 5 years. So let's say someone wants to exit the deal. So how do you do it?
So this is a great question. It's a really great question. When I got into this, part of the reason that made it attractive for me to get into syndication and partnering with people, prior to 2019, I've never taken on a partner. I've done everything myself. Part of what made it attractive is I get a portion of the profit for, if I do a good job, the property goes up in value. If it goes up in value, I get a portion of that profit that I made. If an investor wanted to leave, I can use my portion of the profit to buy them out. So at year 5, there's a cash out refi. The investor wants to leave. That's a perfect time to say, okay, anyone who wants to leave is welcome to leave, and we'll buy you out based off of the appraisal. So then I can buy out those investors, the limited partners, and I can own a larger share of the investment. Most of the investments, either between me and Nancy, we're at least 20% owner, if not more, of every investment we've done. Because we buy properties that we believe are worth holding long term. So if someone wants to leave, that's fine by me. I buy them out. But what's been great is that most of our investors, people that invest with us, think similar to us. So most of the people who actually want to exit have either a daughter getting married where they have to pay for their wedding or some type of life event that requires them the cash. If that happens, again, we let our investors know, we have someone exiting from the fund. We have a $200,000 place to fill. Does anybody want to buy that other person's share? So you went from having, say, 10% ownership share, and you bought out John that has 20 or another 200 grand. So you can buy his share and now have 20% of that investment. A lot of people, when they are attracted to the investment that we have and they feel comfortable with it, they like buying out other investors because they don't have to think, is the next deal going to be good? They already know it's good. They've already had 5 years of experience in it. So they'd rather buy out the other investor and increase their share of that property. So there's either I or another investor or a new investor would replace them.
That's very great. I like the fact that you invest a lot in your own property, and it's one of my own requirements for many when I do, limited partner with other people, is I make sure that they at least also invested in the property themselves, because at least, they have a skin in the game. And the truth is, if you're really confident of your deal, then you should be putting a lot of money in it, because, most of our deals, I'd rather buy it myself, right? If I have all the money, I'll just buy it for myself, right? So the only reason why you get an investor is because you don't have enough money to buy it yourself. So, so when you have the chance to buy them out, I'm also curious, just to follow up on that question, is how do you determine? So you say you base it on appraisal, but how do you determine exactly how much to buy them out with? Like, let's say I give you 100K, okay, 5 years ago. And now this is 5 years now. And I said, I want to exit. I'm doing this because I want to learn it myself. Okay. Find a way to do that potentially. So can you please explain how you come up with that number to buy them out?
Well, if they wait to the refinance period, I don't have to make up the number. The refinance has an appraisal, and the appraisal tells us what the number is. Okay. So the appraiser is a third party. The appraiser is going to, our goal is to get the highest appraisal possible. The higher the appraisal, the bigger the cash out refi is. At that point in time, if anybody wants to exit, we will know what the value is, because the appraisal itself is going to say this property is worth $1 million. So we know what it's worth. At that part, if the person has 10% ownership, it would be 10% of the $1 million. That's what their portion is, minus the initial debt amount. So the math is pretty simple, because appraisal tells you how much the value of the property is.
Okay, so just based on the split that you're splitting at. So if the split was like 50-50, 70-30, so you just go.
Okay, so you make a good point. So let's just say, all right, let's just say it's a $7 million deal. The property was $7 million. The purchase, down payment, everything was $7 million. Now the property's worth $10 million. The person is a 10% owner. So the profit there is $3 million. They get 10% of the $3 million, 300 grand. If the split was just, say, hypothetically 50-50, they'd be entitled to 150,000 on top of whatever they paid initially. So if, let's just say they paid 100,000 initially, they get 150 plus their 100, they get 250, they're done. And then I'll put the 150 out of my portion. Here you go. Here's the money. I'll pay it out of my portion to you. I bought your section, your portion. So now I have an extra 10%.
Okay. Yeah. I mean, that's, I get it. So now I'm going to add this one.
One other thing, we're going to get into tiny details. Like one portion of the tiny details you guys need to remember if you're going to do this is that you're also going to need to charge them 7% real estate transaction. Normally, when you exit a deal, you're paying title, legal fees, all the fees, right? Real estate commissions, that's normally 7%. So you also have to take 7% off of that number, because when you say you decide to sell the property a year later, something happens and you're like, you know what, we're selling it a year later. You're going to pay 7% commission on whatever you sell it for. So you also have to take out the 7% commission, and you're going to make believe you're selling it at open market. Because if you don't do that, then later you're going to be paying it, and then you actually overpaid. So you have to take out the hypothetical real estate commission from that amount as well, so you can model it properly.
Makes sense. I'm going to just ask this question from Mayo. Do you want to come on, Mayo? Okay, I'm going to just ask it. So he's asking, in the off chance that the appraisal is lower, do we get the original 100K back still, or we take a loss?
Well, that's an odd question. So this is not odd. It is, there's many nuances to that question. So there's assumption that, let's just say again, same example, $7 million. If you're saying it's lower than 10 million and it's only 8, then you only get the profit on that 1 million. If you're saying initially we bought it for 7 and it appraised for 6, yes, limited partners would take a loss if they exited, if they left. If you don't leave, you don't take a loss, because it's only a paper loss or an appraisal loss. The reality is, if you buy your property right and you're doing full value add, the appraisal should not be less than, I'll give you an example. I bought a 2-family property in downtown St. Pete in horrible condition, and we paid $640,000 for this property. This is when interest rates were only 4%. We spent $200,000 on the property. So we're in for $840,000. And the interest rate now is 7%. So for a $1 million plus home, interest rate has a large impact on their resale price. So we thought it should be sold for, 1.2, if we get lucky, 1.4. We're not planning to sell it. We're just planning to keep it into a cash out refi. We got the appraisal back now, and the appraisal came in for $960. Because interest rates going up, almost doubling, had an impact on this property. But we're still cheaper. It cost us, all the work we did is still less than what it's appraised for. So we still made money. We just didn't make as much money as we wanted to because of interest rates. So for someone to not be successful, it requires many things to go wrong. Normally, it's 3 big things have to go wrong for a deal to go bad. So in our case, interest rates doubled, which has never happened almost ever. Yeah, it's never happened. Doubling. On top of that, the cost of construction doubled. So we were going to go for about 100. It was about 200. So between those 2 things, and then the third thing, permitting and construction, how far behind everything is, took us about 4 months extra. So those are the 3 things that went wrong, and we still made money. Now the question comes to is, if the person wants to exit, they would exit, but the profit's not going to be as great. I think interest rates are going to be normalized by 2025, which means I believe they're going to be less than what they are today. So if we wait till 2025 to do another cash out refi, we should have prices higher, interest rates lower. So we'll be able to do a good cash out refi, and our mortgage should go down. So with real estate, why I like it. So I was top of my class in investing. I had the largest profit return on my stock portfolio in college. Why I don't like investing in the stock market is because the game itself is rigged. With real estate, the benefit is, even if they make all these mistakes in the financial system, if you manage the business properly, you're going to make money. I like real estate. I like housing. I like the needs. KOR Capital Fund isn't just because of my name, Korkis. KOR Capital Fund is because we invest in the core items, things you have to do. I would tell people, I do taxes because you have to do your taxes. I do insurance because you have to have insurance. And I do housing because you have to live somewhere. Just like medical field, good economy, bad economy, it doesn't change. You guys have to be hired. They need you. It doesn't change. So what changes is, when can you exit? It might not be the right time to exit today. I bought I'm 23 years old. That was 2008. So at 23 years old, 2008, had $3 million portfolio. By 2009, it was worth like $1.5 million. People were giving up their properties. And they were telling me to give up the properties. I said, no. And they said, why? You owe more money in loans than what the property's worth. I said, what does that matter? You guys today have more student loans than what you guys make in a year. Are you guys going to quit working? No, you're not going to quit your job because your student loans are higher than what you make in a year. It means you're going to work longer. So when real estate values shrink and your loans stay the same, you don't quit the business. You don't let it go to foreclosure, which so many people did. They make no logical sense. I said, it doesn't matter what your loan is, as long as you're making more in rent than what your loan is. That's it. You're making that cash flow. I held those properties. I held those properties till today. And the same properties today aren't worth 3 million. They're worth 9 million. But if I did like what the rest of the people did and just let them go, I would have nothing except bad credit. Now I have an 800 credit score and over $10 million worth of real estate because I've acquired more properties since then. So on my personal portfolio, I'm probably at 15 plus million, just what I own by myself. So I think you guys are getting the picture. Most people will show you real estate as a financial investment, and it is a good financial investment. But you have to look at real estate as a business. What is this business? What is it doing? What makes it special? All of our properties are very close to the hospitals. Our properties in St. Pete are next to 3 hospitals. Many jobs from New York City, many headquarters from New York City are moving to St. Pete. We're talking about between the 2 that came recently, that's 400 jobs that are $100,000 a piece. What that means is the $100,000 salary can afford a $3,000 rent comfortably. $3,000 for a 1-bedroom. All the new skyscrapers, rent is $2,700 to $3,000. Some even more if they're closer to the water. They're like $3,700 for a 1-bedroom. We have a brand new, fully remodeled 1-bedroom, 500 square feet, and we rent it for $1,900. Nurses, professionals, athletes, vacationers. So when you have affordable luxury, you have more of a consistent tenant to rent to. It's the business. The economy, it doesn't matter what's going on with the economy. If someone gets hurt, they're going to the hospital. So another good example, what's another good business? Air conditioning company in Florida. It doesn't matter how poor you are. If your air conditioning goes out, you're going to find someone to let you borrow money so you can fix your air conditioning. Heating. So there's certain necessities. If you invest in them, you know that there's going to be a consistent client base for it.
True. George, you have something?
No, I do have something, but I want to jump to chat where there's a question from Razak. I hope I said that right. Thank you so much. Can you talk more about the infinite returns from the perspective of a limited partner?
Sure. Most investment funds are set up where the general partner will buy a property in 3 years, 5 years, or 7 years. They'll sell it, and they make their money off of the sale of the property because they get a big chunk of money. And that's what they go for. They want that big chunk at the back end. Me personally, it doesn't mean anything to me. I like cash flow. So I don't want to sell a property. If I have to sell a property, I have to pay all these transaction fees, these expenses. When you sell a property, the logic behind why it's not a great idea. If I sell a property, and this is how it works. I sell a property to Bayo. It's $1 million. I sell it to him for $2 million. Bayo buys it from me. His property taxes are now off of $2 million, not $1 million. I had half the bill he had. Bayo keeps it for another 5 years. He flips it to George for $4 million. George makes a big waterfall. He's happy. Sells it to George. George keeps it. He's not paying property taxes on $4 million. If I kept it and just did a refinance and then another refinance, my property taxes would still stay at the lower. It still goes up, but it wouldn't be $4 million. It would be maybe 1.5. So I do cash out refis, get my money back, and have the lower property tax bill, which makes my margins fatter and fatter. I have a property that's worth $3.5 million. It was the third property I bought. I bought it for $335,000. I bought it for $335,000 like 15 years ago. It's worth $3.5 million today. And I'm paying property taxes for $500,000, $600,000. But if I sold today, it would be $3.5 million, and that person would pay for $3.5 million. $35,000 a year in property taxes. I would pay, I think, like $8. Now I got my cash. and I got a low tax bill. So why do I got to keep flipping to new deals? Because eventually a guy like me in this example would then buy it back from George at $8 million, because the standard GP model, they make their money on the sale. So we just keep on selling, because that's how we make our money in the back end. I don't like that. I don't think that if you're a real estate investor, that doesn't make any sense. You want to hold it. So in that period, during the sale, the LPs leave, GPs take their money and they leave. Some GPs, general partners, will do a cash out refi, pay off all the limited partners, and then keep the property for themselves. Some people do that. I don't think that's fair. I think we can be partners. I win, you win. We all win. So if my plan is to keep it, but at year 5, if you want to leave, you're welcome to leave. Just let us know. We'll buy you out. You can leave, but you have the choice to stay or go. At that point, we keep the property. We own it. And every 5 years, we do a cash out refi. You'd get a distribution. It's not taxable currently under current tax law, and everybody wins. If you want to leave, you can leave. If you want to reduce your position, you can sell a portion off. If you want to buy out another member, you can buy them out, because you guys are welcome. If you guys all together came and did a deal with George or Bio or me, you guys are a team. You can figure something out. If somebody needs to leave, another member can buy out their portion. So this is the way that I see it, because again, I see it as a person running a business, running a real estate business, and really running each property like its own business. It's not an investment. And you change your thinking. When you have an investment, a lot of people don't care about it. But if you run it like a business where you're caring about your clients and your partners, you act differently. You treat it differently. You view it differently.
Hey, Baskal, can you talk about the tax profile of just the cash flow itself? We know, like, when you get the cash out refi, that's not taxable. So that's advantageous to stay in the deal. But what about all that cash flow? How is that taxed or not? What are some strategies with that cash flow that you get?
So this is what's really great. So Donald Trump says he only pays $750 tax bill. That's because he's smart. I've never paid more than $1,000 income tax ever. Even though I have all those other companies and I have the rental income, I've never paid any tax. How this works, and it's really, I already explained how the whole thing works, but it's so much information. It's kind of like the beauty of it, the simplicity of it, it misses. So all right. All right. Is it Temi? Is that how you say her name? Temi? She's showing me love, so I'm gonna show her some love too. So Temi invests $100,000 into Bayo's deal, and after 5 years, he does a cash out refi and he gives her back that $100,000. Now let's just, everything's going awesome. They're making money. She's making $5,000 a year from that deal. It's considered rental income, which is at a lower bracket, and it's considered passive income, which is a lower bracket. But from there, when Temi reinvests that $100,000 into another deal, she should get another tax write-off from the depreciation. And that tax write-off, if she is not a real estate professional, it is going to go against passive income, like the rental income. So even though she made $5,000 positive, she'll have a negative $95,000 on her tax return that will flow forward to future years to counteract all the money she's making. So then as the second deal starts making money, and now she's making $5,000 and $5,000, and eventually say $10,000 and $10,000, she's bringing in $20,000, it's being eaten away by that $95,000 that she has negative on her tax return. So she's not paying tax on it. So it flows forward. Let's just say Bayo decides to sell that deal and there's a taxable event. She still has that negative dollar amount on her tax return that will go against a taxable gain that she would get from the sale. But then whatever profit she got in her hand, she can then buy and invest into another property and then get another tax write-off. Or Bayo can say, I'm going to do a 1031 exchange and just roll all the profits for all the investors into the next deal. So there's multiple ways to do it. It can be done. So normally you could do, so we do consulting as well. So you can hire a consultant, they give you the strategy, and then you would choose to take which strategy you would like. And then from there, you would tell your tax advisor and tell your investment partner, hey, I would like to do it this way. And if they listen, hopefully they will listen, and then you get the benefits.
And kind of related to that. Oh yeah, go ahead, Bio.
Yeah. So usually it takes a while to start rolling over. So actually, George is going to be the best person because you've been limited partner for like 23 deals. So you, by this time, you shouldn't really be paying tax on any of your profit, because as you're exiting one, you're getting K1 depreciation for another one, exiting K1 depreciation. So it will just kind of roll into each other. So just wanted to add that.
It should, but the example I was giving is if you made a crazy amount of money on one deal, because if you hold a property for 5 or 10 years in an up market, you know, you can make, you know, more than 3 or 4 times your money. And if you did a cost segregation on that investment, you also have a reduced basis. So you can end up walking with 2 million, but have 4 million in taxable liability because you already took the depreciation basis earlier. So there is a time where it could be different, but normally most investors will, at that point, when they're that successful, they're getting professional advice and they're figuring out another way around.
Similarly, what's your kind of approach to recapture? You know, what is recapture? First of all, I feel like that's something, you know, newer investors kind of, you know, want to learn and understand, and it kind of sneaks up on people, right? So, yeah.
So the best way to explain recapture is if you had a business and you bought a truck, and because the truck's over 6,000 pounds, you can depreciate the full vehicle value in year one. So $60,000 truck, year one, you can depreciate the whole thing and get $60,000 off of your income taxes. And that would usually reduce your earned income taxes, which is your higher tax bracket. Let's just say it's 37%. Now, you decide that in year two, you're going to sell the vehicle. So after 1 year, you sold the vehicle and let's just say you got $40,000. When you sell the vehicle, your basis in that truck is now $0 because you took all the depreciation last year. So that means when you sell it, you made a profit of $40,000. That is taxable. It's called a recapture because you depreciated all of it before, but you have to take it back now when you sell it. But you're selling it as a long-term capital gain. So when you're selling it, it's at the 15 to 20%, not 37 of earned income. And then if you have real estate losses, you can take your long-term capital losses against your long-term capital gains. So you can write it down to zero also if you have those losses built up. So that's what recapture is, and that's how you're going to account for it. So in that simple one-for-one example, you can say, okay, I have $40,000 of recapture gain as a long-term capital gain, but I have this new real estate long-term capital loss to subtract from it. I can write it down to zero. In that same sense, you can have a recapture on a real estate deal if you did that on the building itself or the portion of the building that you're allowed to do that on, say a 5-year life item. When you're doing another real estate deal, God willing, things are done right and everything works out well, you'll have a long-term capital loss that would be this around the same lifespan of the other one, and it should help. If it's done properly and you're investing wisely, it should help zero it out. So everything I'm saying here is planning, 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 planning. Have a plan, have a strategy, have experts that are able to guide you. Everybody here is a doctor, so everyone knows that our patients come to us and they're asking for our opinion, and they get a second opinion and a third opinion. And you come to your family doctor, and then you send them to a specialist. It's no different in the financial sector. My mom was a midwife overseas. She would drive her Jeep into the desert and deliver babies in the desert, and which is a crazy thing on its own. But when I've been surrounded by medical professionals and I understand this field, and when I go into finance, it's really no different. The financial system is really no different. Everyone has an expert, and that you always get a second opinion, and you always have a plan of how you're going to get to the result that you want to get to.
All right, we have a question from Temi. When does the recapture come into place? Is it always at the time of the sale? And does the amount decrease the longer you are in the deal?
The recapture normally pops up during a sale. And if you keep the truck for 5 years, there is no recapture. You just have standard sales on the asset. So the recapture kicks in is if you have where you might see a recapture is if you have a 7-year life item on the building and you've only kept the property for 5 years, then you'll have recapture for those 2 years. So you're not going to recapture the full amount. You're only going to recapture the depreciated value of the 2 years remaining. So there's a lot of math involved in calculations. So yes, you are correct. Time of the sale, reduced amount based off of the useful life.
I think Mayo also asked another question about when one partner buys out another partner, is there tax benefits as if you buy in original transaction?
That is a very complex answer. That is not that straightforward. It depends, right? There's a lot of it depends involved in that answer. It depends on, is there anything else going on? Then the answer might be no. You just have to take over where they left out. Or are we then taking that cash and doing any type of value add to the property? Then there's a way sometimes you can position that value add towards that one partner for that contribution. So it depends on how you structure it. Oh, and also to continue on that thought, in my deals, how I structure them is I don't take any of the depreciation. None of the GP team gets any of the depreciation out of the deal. I only let the limited partners get the depreciation. So some people, when they structure their deal, they'll take some of the depreciation as well. So I don't do that. I'd like to pass it along.
Okay.
Well, if we
Maybe asking who's going to help you structure. So, I mean, you could, talk to a tax professional, ideally a tax professional who is also good with real estate at the same time. So that's
Not all
very
tax professionals know. But most tax professionals do not understand real estate. You have to go to a specialist because most of the things we talked about, 99% are going to say that's not possible or something to those lines because they've actually never done it before. They've never even heard of it before. You definitely have to go to a specialist that understands that portion of the tax.
Awesome. Well, folks are still, you can put more questions or comments in the chat. I don't know if Bio has any more questions. We're at 5:09. There's definitely tons of other ideas and concepts that Baskal can speak upon, but I definitely want to be respectful of his time and everyone else's time. We appreciate you kind of coming in even through the family. If the GP doesn't take depreciation, how do they reduce their taxes?
They invest in deals. Like me and Nancy, we invest large chunks of money in our own deals. Bayo invests large chunks of money in his own deals. So when he invests in his own deal, he gets a write-off. He gets depreciation passed forward through him as an LP.
Yes. So a GP can also invest as LP.
And they should.
Yeah, they should.
Yes.
We are all invested as LP. And sometimes we're one of the biggest investors. Just like Baskal said, they have 20% in the deal already. So if so that's a big chunk. So it's quite interesting way to structure the deal. And I just have one question of mine. So what kind of splits do you normally do in your deals?
So we normally do like a 6% pref, sometimes an 8% pref. It depends on the deal. And then from there, it's a 50-50 split. Once we give the person back all their money, because our goal is to give everyone back their money within 2 years. They have 100% of their money back, and then we're 50-50 from there at that point. So basically, once you get your money back, we're 50-50 on everything. And my goal is to be able to roll that person's money. Let's say it's 100 or 500, whatever it is. My goal is to roll that person's money 5 times in 10 years. So if I can get them into the same, 500 grand into a deal every 2 years back to them and in another deal, by the end of the 10 years, they'll have 5 different investments that are going to pay them a cash flow. And if they have a longer investment horizon, 20 or 30 years, constantly rolling that money. So eventually, as they make more money, they add even more money on top of it, and it rolls bigger and bigger. So then you end up having in real estate, as you guys know, because you're investors, that reinvestment snowball becomes very large. It gets bigger and bigger and bigger how much money you're reinvesting. So you're getting more and more deals. So year one, it's or the first round is you do 1 deal. But normally the second round, you're doing 2. The third round, you're doing 4. The next round, you do 8. Time after that, it's 16, then it's 32. So before you know it, it snowballs very big. So my goal is to get people into as many deals as possible, get them back their cash as fast as possible so they can constantly roll their money and grow their portfolio and have multiple funds paying them out so they have a diversified portfolio.
Someone asked how to find a specialist. Correct me if I'm wrong. Do you also do advising, right, Baskal?
So we do advising, and we have an accounting firm as well. So we'll do tax prep, corporate tax prep, bookkeeping, payroll. We have an office in Florida. So some clients in California have a business, and they want to run their business out of our office in Florida, which helps them avoid California tax. So there's a lot of ways that we can set up a strategy call and figure out what is a person doing, and then give them suggestions on which is the best way to structure their operation.
I wanted to add to that, strategy that you can use, Joseph, is to attend different real estate events, because where the real estate investors are, you're going to find all the vendors for that. You're going to find, real estate minded lenders, CPAs, attorneys to set up entities. So, that's a good place to kind of find those folks who are specialized.
You can also ask people, they'll, send you referrals of who they use, right? And, so if few operators, we have few people that we used, few people that we can recommend. And, we always know Baskal. I'm sure he has friends.
Yeah. First question is, ask them if they don't pay any income tax. If they pay income tax, then find someone that is seeing an accountant that is not paying any income tax or has had their income tax cut, significantly, 50, 70%.
That's actually important, because the mindset is important, because many of the CPA that I talk to, they're not ready to walk that line,
And
so
if you
they'll,
own your own,
yeah.
and if you own your own building, it's even better. Because as a doctor, you're like, a lot of my income is earned income. But if you own your own building, it becomes very easy. Like, here's a tip. If you're a doctor, you own your own building and you're running your practice out of it, you can charge yourself a lot of rent. So then a portion of your profits isn't coming in through your, say, as earned income, it can come in as passive income from your rent. So now you have all this passive income from the rent that's owned by an LLC that's separate from the LLC that's running your practice. That now you're bringing in, say, $20,000 a month in rent. You make $240,000 a year. That's rental income. You invest in a real estate deal, you get a write-off. It can reduce that income. One, you reduce how much you're making as earned income to passive income, which reduces the bracket right away. And then on top of that, you would then invest the funds to get write-offs to reduce your passive income.
I love it. That's awesome. All right, question from Razak. Could each of the panelists comment on how they advertise their deals LPs can get in? I'll let Baskal start.
We have a website, KORCapitalFund.com. So it's KORCF.com. So it's core, like my last name.
I'll put it in the chat.
Charlie as in Frank.com. Tax. That's also TaxSmartInvestor.com. That's our website as well. So you just sign up for the newsletter, and then once in a while we'll let out that, hey, we have an investment coming, and that's what we do. A lot of people just keep in contact with Nancy, and they'll know, because sometimes deals will pop up and we'll execute and the fund will close within like a week, just because deal will come up, fund will close within a week, and then we'll finish it. So it's, I mean, just, we're people, we just communicate with people. I mean, George and Dale also know about my deals, and we're talking about doing some deals together. I mean, if we have time, I'll tell you about the new thing we're going to be doing in St. Pete. That's if we have time, George and Dale, I'll mention that. It just started last week. We started it.
We actually have we have a few things. We're even thinking of doing the carbon capture potentially through Baskal Fund, combine together and get into the carbon capture deal. But we'll figure out the kinks and let people know later. To get in touch with me, usually we get your email. We have a website. Through our website, you can just log in on our portal. We prefer that because then you get all our emails. You can see all of our deals on the portal. And also we have a WhatsApp group. We can, we're going to send emails to everyone that came to this webinar, and we're going to give an opportunity for a one-on-one talk with Baskal, me, or George. And then through that, because we like to get to know our investors or prospective investors, then, then we can see whether we fit, there's synergy between us and whether we have what you're looking for. So if you don't, I'm going to type in mine while George speaks.
I typed in everyone's. And so, yeah, I left mine there. It's timehealthcapital.com. It's just pretty much what Bio said. There's many avenues that we use to reach out and contact and start conversations and strategize. So, I'm on social media as well, probably most active on LinkedIn, but timehealthcapital.com is the best place to start.
If you want, I can show an example of one of our properties.
That'll be awesome.
Yep, let's do that, and then we'll close.
Do I have screen share ability?
Oh, let me give him. Oh, I think you can give him also.
I should have just done it there. Try now.
Everybody see that?
Yes.
So this is one of our properties. This is the one that I bought 15 years ago. I did a full remodel on it recently, about a year or two ago. And this is about 450 square feet. It's down the street from a hospital, from a spring training baseball stadium, 2 blocks on the water. walking distance to downtown. Then 450 square feet, 400 square feet, somewhere in that range, and just everything you need. Herringbone tile, white granite countertop. I think that's Carrera countertop.
And again, this was gutted to the strips, right? Or to the stakes. So this is essentially like a new home.
Yeah, because what we left the block. You
Right.
know, we left the block, spray foamed everything, and it's very energy efficient. Mini splits, so there's no filtration system. Magnetic shower heads. The ladies like that because it's easier to wash the hair. We just really think about what does our client want, and we want to provide them that value.
Yeah, we went down there in early January. I was just super impressed. When you walk into a new home, you can smell everything. You smell the paint, the wood, but when you walk into one of these homes, it just smells like normal. That's the best way I can describe it. It's just normal. It doesn't smell like any chemicals. It's pretty interesting stuff, man.
So we're very green, very clean. So we don't put in products that off gas. So our paint doesn't off gas. All of our products are low VOC products. You can see this is a plug for a Cat 6, so you can plug your laptop directly into the internet. So you don't have to go through Wi-Fi. So we have Wi-Fi and we have that. Because if you're doing a Zoom call, you need a strong connection. We have US Type B and Type C plugs. Another one in the kitchen island, so they can work from the kitchen. This is the front with the shell. We're 2 blocks in the water. It's the baseball stadium next door. Oh, that's Honeymoon Island. It's really great beach, really close by. This is the downtown with all the little shops. All of the properties we buy, we like to have it into like a real downtown core where you have the walkability. So you can work at the hospital, walk home or ride your bike back home to the property, ride your bike down to downtown, bring your dog downtown to the water or any of the shops. They allow pets. And it's just a, great place to live. Over here, you can walk right here on the water. Great views of Clearwater beaches on the other side. This is Bon Appetit. In all of the different cities, we're in like 4 different cities. Downtown Dunedin, downtown Safety Harbor, downtown St. Pete, downtown Gulfport. So if you see what they'll do is on the weekends, Friday, Saturday, Sunday, they have all these little tents that pop up and you can buy food, vegetables, knickknacks from these tents in downtown. Once a month, they'll actually shut down the street on each one of these cities. So you can go from each pub and just get your drinks and walk down the street, and it's open container. But it's not like Mardi Gras where it's wild and rowdy and dirty. These are tons of police everywhere. This is families with their pets and their children, sometimes grandparents as well. So these are really clean neighborhoods, middle class, upper middle class neighborhoods that you have a high standard of living. So this is it. And actually, I'm going to see, and then lastly, I'll just show you. So this is Tampa Bay. This is Clearwater Beach. And our properties are here by the water, over here by the water, Safety Harbor, downtown St. Pete by the water, and downtown Gulfport by the water. And our next investment is actually in St. Petersburg, our next project that we're doing.
Very cool stuff. Well, we're almost 30 minutes past the hour, so I definitely want to be respectful of everyone's time. I think we've learned a lot here today. Baskal, I want to thank you for taking the time out and educating the community. And we definitely hope to hear more from you. And if anyone wants to reach out, the information's in the chat. Thank you guys again. We do have another webinar coming up in 2 weeks, April 15th. That will be Wagner and Alaska. We'll be talking about build to rent, turnkey, single family, multifamily home opportunities. So we look forward to having you guys come back for that event. Baskal, any final words?
Thanks for having me. You guys were great questions, really smart questions, and it was a lot of fun.
Okay, just want to say thank you, Baskal, for coming. It's like as we're going to be seeing a lot of each other, either in multifamily, single family, or the carbon capture deal, or just to hang out. Okay, so well, thanks for coming, and George, thanks for being a great host.
Awesome, no problem. Thank you guys. We'll see you next 2 weeks.